morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show, John Zechner, chair and founder of J. Zechner Associates, will be with us for the hour. Then in 30 minutes, the U.S. will be releasing jobs data the first time since the government shut down. Alex Gracino, global chief economist at Manulife Wealth and Asset Management, will be here to take a closer look at the numbers, what they mean for the U.S. economy, and possibly for us. And of course, we want to hear from you this morning on First Call. Reach out with your questions on North American large cap stocks, and we'll have John answer as many of them as he can at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Shopify are climbing in the pre-market, up about almost 11%. At one point, they were up as much as 14%, I should say. The e-commerce firm beat revenue estimates, which saw a 31% rise in fourth quarter. The Ottawa-based company says 2025 saw strength in merchant sizes and regions, adding it set the foundation for a new era of AI commerce in the last year. Shopify has also authorized a share buyback program of up to $2 billion US. Going the other way, Lyft shares are plunging in the pre-market, down more than 17% after the ride-sharing company missed revenue expectations in Q4 and posted a disappointing forecast for 2026. The company says lower than expected revenue is partly due to more than $165 million in legal, tax, and regulatory reserve changes. The CEO adds that 2026 will be a transitional phase for Lyft, calling it the year of the autonomous vehicle. Bombardier says it has won a 40-plane order for its Challenger 3500 from private jet firm Vista. The more than $1 billion deal sees Bombardier delivering aircrafts over the next decade. Vista says it also has the option to purchase another 120 planes in the future. The deal comes after recent comments by U.S. President Donald Trump. He threatened to impose 50% tariffs on Canadian aircraft and restrict them as well. And now our top line story. Shopify has reported revenue for the fourth quarter that beat the average analyst estimate. To get into the tech company's earnings, let's bring in our guest for the hour, John Zechner, chair and founder of J. Zechner Associates. John, always good to see you. How are you, sir?
Hey, Roger. Good morning.
Are you as good as Shopify, or is Shopify looking as good as we think it is?
It's a great number, Roger. I mean, in this environment, everybody's been very worried about software stocks in general. I wouldn't, necessarily call Shopify, a SaaS provider like some of the other ones that have been under pressure, but certainly, an e-commerce facilitator. And they'd been growing revenue in sort of the low 20s throughout the pandemic, and then into the mid to high 20s. And I think getting over that 30% bar is going to put a lot of worries at ease for now. It's interesting too. We saw a couple of upgrades in the past 2 days before the numbers released. And it's always brave for analysts to upgrade in front of an earnings number. So I guess there was some confidence out there. There's probably a little short covering this morning. I mean, that the move we're seeing in the pre-market will be good for probably 100 points on the index overall. So it'll give a lift to the Canadian market. But it's a great story. They continue to grow, and that's a fantastic number. They're facilitating mid and small businesses access to the to cloud services. To effectively to retail, and they're really sort of migrating as well as any software company the use of AI into the knowledge of their customer base and using that to improve the sales and profitability. I mean, if there's any negative that might hold it back a little bit is costs continue to rise. The margins, the free cash flow margins, from what I've seen, and the overall margins are probably coming down a little bit, which is it's just the cost of doing business. It's just sort of as you grow, you have to sort of put more money into this. And they've been through a pretty big CapEx spending phase. I think they're starting to realize that they do have a lot of free cash flow. And so initiating the buyback is the other tailwind for the stock this morning.
Now, what do you think of the comments from the president, Harley Finkelstein? 2025 with Shopify at full throttle, driving compounding growth while laying the rails for the new era of AI commerce. Will this restore some confidence with tech that AI is going in the direction everybody is hoping it would go?
Well, I think it's a real sort of pick and choose, Roger, there, because it's going to go from company to company. We're going to have to see a lot more reports of similar commentary and similar growth profiles too, because we know the market right now is paying for revenues. You saw that with the hyperscaler reports where you have the positive aftermarket reaction from Meta and the negatives on Amazon and Microsoft. So you've got to start driving all this spending into revenue growth through the AI channels, but they can implement it better. I mean, Shopify, this helps their customers know their own customers better, and if they can get a higher level of sales, they get more specification, they regions knowledge of what the customers are buying. That just improves their productivity, improves their overall sales. So that it's just, if they can incorporate that, it's fantastic. I think the worry is more in the markets is some of these bigger application software companies, the embedded systems, the old license, SaaS providers with packaged software. Are they going to be they're sort of seeing their growth slow down dramatically and their prices come down and the number of seats they're using decrease because AI will start to take some of that business away from them. So that is the bigger question. I still have my doubts. I think they've got too many worries about it. People, you're not going to suddenly have AI do your taxes instead of Intuit. There's a lot of these things you're not going to shift over. I'm not going to have ADP. I'm not going to have AI do my payroll instead of ADP. So it'll take a while, but I think Shopify is in a better position, to migrate over to the use of AI, implement it, and get greater productivity from it. And that's what the market wants to see.
Now, all those companies that will probably implement AI. Is there the danger, though, that we could hit a point where AI can't do any more for us when it comes to industries like Shopify? Like when you know everything about your customer, how much more can you know?
Well, that's a good question, Roger. I mean, at this point, there's also the privacy side of that same argument. People get a little more defensive about that. You're going to start blocking the access to this so they can't see and they can't follow. So, that is going to be an issue going forward. For now, it just helps them target their marketing so much better, which is why you've seen, online advertising, have success in the past couple of years. Why, Meta and Alphabet have gained so much ground, on their cloud services and what they're providing to their customers, because they can target more effectively. So I think there's still a long way to go, but there are other concerns, and it's not unlimited, the gains. But yeah, at some point, what are the ultimate benefits? Can you increase the benefits? And then the bigger question is, do then they continue to spend on the CapEx side to the same degree we've seen? Because that is, that's the big tailwind lifting the entire economy and the market, is this a crazy level of spending like that we're seeing. I mean, obviously what we saw from Amazon and Alphabet in particular just raised the bar substantially.
Okay, we're going to have to take a break on that note there. John, but thanks as always for joining us. Up next, we'll take a look at the markets before the bell. All right, let's take a quick look at the markets. We'll start with the U.S. futures. They were down earlier, but they're mostly flat now. They await the delayed non-farm payroll reports, up ever so slightly, but not much. Worth mentioning, over to Asia now. The Nikkei is closed for a holiday, but you can see the Hang Seng up, while the CSI 300 going the other way by about 0.22. Off to Europe now. Tech and some financials were dragging some of the markets down there, but FTSE having a good day, up by 0.73. CAC 40 and German DAX off. TSX, record finish for the day yesterday. The bounce back continues. It closed at 33,256, up by 0.71%, and will likely possibly surge again today with that Shopify news. And some of the winners and losers from yesterday. Shopify was a winner yesterday. We'll see what happens now. 7.41%. ATS Core up 4.5%, roughly. Energy Fuels down by 6. Celestica down by 6.6. Going to the metals now, and everybody is in the green right now. Silver continues that roller coaster. Gold's up above 5,100. Silver up above 85, and copper topping $6 again. Going to oil, and you can see WCS off day yesterday, down about 1%. And south of the border, WTI continues to surge, up over $65 a barrel. Well, U.S. President Donald Trump's latest dispute with Canada is over the opening of the Gordie Howe International Bridge. CTV's Mike LeCouture has more on the Prime Minister's response.
Canada, of course, paid for the construction of the bridge, over $4 billion.
Prime Minister Mark Carney said he laid out that fact to President Donald Trump in an early morning call that he described as positive. He also cleared up Trump's misconception about the construction and ownership of the span.
See, there's Canadian steel, Canadian workers, but also U.S. steel, U.S. workers that are involved. This is a great example of cooperation between our countries.
Contrary to Trump's claims, the 2017 agreement clearly spells out that the crossing will be publicly owned jointly by Canada and Michigan. Yet Trump's officials insist there are issues.
There's a question as to the proceeds of tolls, et cetera, and so there's going to be a negotiation on that front.
The agreement states Canada will collect tolls until it recoups the costs related to construction. After that, they're split between Canada and Michigan. One former ambassador says there's a reason the president gets things so wrong.
You've got a bunch of crackpot advisors in the White House who misinform the president, who already likes to have tantrums and lash out.
The New York Times is reporting the owner of the older Ambassador Bridge, Matthew Maroon, lobbied the Trump administration on the same day the president unleashed his tirade about the Gordie Howe span.
The Maroons are the only party that benefits from delaying the bridge. They make a lot more money at the expense of Canadian and American consumers and everyone else.
Ontario's premier believes there's an economic argument for the new bridge, which could spill over into the American midterm elections.
If, the 13 Congress people, 7 are which Republicans, they start getting hammered by their constituents, watch how quickly they flip.
But before that happens, Prime Minister Carney says President Trump asked his ambassador to Canada and Michigan native Pete Hoekstra to continue the conversation and bridge the apparent gap.
And that was CTV's Mike LeCouture. Meanwhile, Bombardier, which has been in Trump's crosshairs, won a 40-plane order for its Challenger 3500 aircraft from Vista, one of the world's biggest operators of business jets. A lot of their business heads to the U.S. And, of course, Bombardier has been in Trump's sights over all this as well, part of the CUSMA complexity. So we're going to bring John Zechner back in. He's the chair and founder of J. Zechner Associates, to get his thoughts on some of what is unfolding right now. John, the bridge, it's a bridge too far. It's a bridge over nothing right now. Looks like it's going to come and go, doesn't it?
This one, yeah. I mean, the facts are so different from what sort of Trump pontificated out about yesterday. And I mean, that piece you guys just ran from CTV, I think that was accurate. I mean, I get the idea that Howard Lutnick, who met with the owners of the Ambassador Bridge, who are probably, Trump supporters, and he's looking to get money in to help them in the midterms, are complaining about that. They took it to the president, and he immediately sort of, as he tends to do, unsubstantiated, misfactual comments and reacted to that. And, now he has to, never rolls it back, never says I was wrong. But clearly, I mean, this has been in place for a long period of time. It benefits both sides of the border. Everybody around seems in favor of it. So, yeah, this is just another thing we get from Trump, and where we just have to deal with it. I mean, Canada overall, I think, is doing the right thing by starting to diversify globally. We're seeing more and more agreements like that. And at some point, we're going to have more rational, at some point in time, hopefully, Roger, will have more rational voices south of the border. And then maybe we'll have, better global relations, and we'll come back to better U.S. relations at the same time. But for now, it's just a massive headache for Canada, because we're just so in the crosshairs, and we're the easiest target for them because we're close and we have that much business together.
And we're so intertwined, and he knows that we have vulnerabilities. I just want to get your thoughts on the Bombardier deal, not so much the size of it, but the fact Vista announcing that in the middle of everything that's going on with Bombardier, the threats to have them decertified in the U.S. And tariffs on planes built in Canada. But Vista saying, you know what, we're going to announce this deal with Bombardier. And are people looking at Trump now and really everything is a taco? Is that how, outside of America, is that how they're looking at him?
Well, it could be a little of that. I mean, I think what the reality has been on this one, Roger, is that businesses look at this as is the quality of what they're buying, and I think what you're seeing is that Bombardier makes a better jet in the Gulfstream, which is owned by General Dynamics, which is obviously has been in Trump's ear to a degree, and that's why the frustration of the certification of the Gulfstream in Canada, and they're going to go sort of tit for tat on the other side and say, okay, we're not going to certify Bombardier's plane Challenger in the U.S. So, again, sort of myopic back and forth to no end. But I think the reality is that people who have freedom of choice, these international companies are looking at it, and they prefer the Challenger. It's a newer jet. It's more cost effective, and they'd rather buy that. And I just think, hey, good for Bombardier. They've got a better product and they're winning it. I don't understand why, Trump and the U.S. can't, simply understand that, and they have to sort of take different tactics. But then that would be expecting rationality south of the border, and we're not getting that.
What do you think all this indicates as we head into Kuzma? And we heard from Bloomberg that apparently privately musing, we've heard him say it out loud too, Trump is considering scrapping Kuzma. Is this just another tactic by him, do you think, or is he legitimately thinking about getting rid of it?
Oh, everything's a tactic with him. I think Trump's total modus operandi right now is towards the midterm elections. So anything that's sort of help in that regard, in his view, he's going to be doing right now, including when some of his prognostications on economic growth and other things yesterday. So I think whether Kuzma, which he called the greatest trade deal of all time to replace the worst trade deal, which was NAFTA, and suddenly this is not such a good deal. I mean, America seems to think they're slighted on everything, or Trump seems to be. So how negotiations go, I mean, that's anybody's guess. I think ultimately rational heads will prevail because there's more, than the president involved in this. But we're at risk because this is huge for, us, for Mexico, and certainly for the U.S.
All right, John, stick around. We're going to talk to you when we come back. We'll see what's on your radar. John Zechner is the chairman and founder of J. Zechner Associates, and Microsoft is one of the names on his radar. That's up next. Time to see what's on the radar for John Zechner, chairman and founder of J. Zechner Associates. John, first up, you've been watching the software stocks and Microsoft especially.
Yeah, Roger. I mean, I sort of love sort of picking through things when they start getting beaten up and see, where we're going to get relative value. We've been out of Microsoft for a little while now. I just had a problem with the valuations. It's a great story, but, trading at 35 to 40 times earnings always sort of, just was a little too rich. I found other areas where we potentially had better growth at a lower valuation. But the big pullback in the stock, I think, is an opportunity to get back in it now for the long term because they continue to dominate software. I mean, when you look at the operating system for over 80% of the world's computers, and they continue to migrate people to the cloud. I mean, our company is a good example where, Roger, we're a small outfit, and our backroom servers were coming up for, their useful life. It ended a couple of years ago, and I was looking at, $50,000 plus to replace them, or we could migrate everything onto the Microsoft cloud, which we did seamlessly for cost of, a couple of $1,000s. Suddenly cybersecurity is their issue, data storage is their issue, accessibility is there. They look after everything for us, and it's been fantastic. I think they own that. They own the enterprise. They own the consumer, and they're not going to give that up in the short term. So I think they can migrate slowly onto AI platforms, whether there's Copilot, whatever, and they will be able to continue to grow. I mean, Azure is still growing at around 40% right now. So it continues to be a great story. But suddenly, I can buy it about under 24 times forward earnings. So it's to me that's attractive. So it's we've stepped back into it.
Is being big a good thing with AI right now, or is there no?
Well, some of the biggest disruptors are these small companies. What you've seen, you can go back to DeepSeek last year and, some of these players we've seen in the financials recently. So, small guys can be disruptors to a large degree, but the big players have the platforms, they have the data, they have the bigger moats around what they provide to their customers, their enterprise customers, the consumers and everything else, and whether it's data, whether it's application, whatever it is. And I think that protects them better in the long term than, the mid-size and the smaller companies.
All right, and from the cloud, we'll bring you back to earth. Torex Gold.
Yeah, I like the golds generally, Roger. I think what's going on
even
in
with
the
everything
US
that's going on, though, you're not too worried?
Even more so now, because I think what's going on in the U.S. will continue to appreciate the dollar. I mean, when Trump talks about growth of 15%, I mean, like we start to even go down that road. The only way you're going to do it is you're going to inflate out totally, which means the dollar collapses. So I think this weaker U.S. dollar will continue. Meanwhile, the gold stocks are not reflecting anything close to $5,000 an ounce. I think I look at some of the most recent quarterly numbers are reflecting more $3,000 an ounce. So I think there's upside there. I think you continue to see central bank buying, public buying in general, and the stocks on that value are cheap. Torex sticks to me as a particularly cheaper one, trading at a discount to net asset value about 4.5 times forward cash. So Morales property in Mexico was coming to the end of its useful life, or the El Limon deposit. They moved seamlessly to the Media Luna property. They'll replace production completely within a year. So it was a seamless transaction. They're back to cash flow positive, and they've also gone underground both at Media Luna and El Limon, and have found extended their deposits there into the mid 2030s with about a 30% copper content as well. So I think that's a great story, cheaper than the rest, but I like the sector in general.
And any concerns about the Mexican mines with what's been unfolding lately there with that?
You know what, Roger, that's a really good point, because, Torex has had a sloppier week, and I was sort of looking at it, and I thought, I guess, with what's going on, I mean, they're not really close to the Sinaloa cartel or anything like that, but it's probably just, and what's going on with El Paso this morning and things like that are making people a little more worried about the border, and whereas Mexico felt like a very safe jurisdiction, maybe people are getting a little more concerned. I still think, Mexico is not like a lot of the jurisdictions in the world where we were about, like West Africa and South America, and some of the regimes there. I think it's much more stable. So, but there obviously are concerns about the cartels and what happened to, in terms of crime, and obviously the deaths we saw in the the Vizsla Silver are tragic, and it does cast a bit of a pall over Mexican production in general.
All right, and let's get in MDA space before we go. We got about a minute here.
Yeah, it got hit last year on some worries about, say, they lost the EchoStar contract. People worried they're going to lose the Globalstar contract as well. But that won't happen, because Globalstar is Apple's entree into the satellite world, and they continue to provide the equipment. They've added a bunch of additional contracts recently in space. They got the LEO, the low Earth orbit satellites, obviously, in the constellations, but they're getting other sort of space contracts as well, including for the Arctic, the Shield, the Dome. That's a huge contract going forward. So these guys are trading at a discount to the group. They had a rougher year last year. I think it's been a great long-term growth story. It's underappreciated. They're the arms dealer of the space race, and I think they continue to be. And it's a great Canadian company with a good backlog and growing.
All right, clouds, Earth, and now space. We covered it all, John. We got lots more ahead. Stick around. We will be back to talk about some American data coming out today, and also our phone lines will be open soon for our first call segment, 1-855-326-6266, or send us an email, firstcall@bellmedia.ca. Bloomberg News is reporting U.S. President Donald Trump is privately considering exiting the North American Trade Pact. The report says the president has asked his aides why he should not withdraw from the agreement. This week, U.S. Trade Representative Jamieson Greer said the administration would hold separate talks with Mexico and Canada, arguing that trade ties with Canada are more strained. Shares of Kraft Heinz are falling in the pre-market, down about 7%. The American firm is pausing its planned split into two companies. The CEO says challenges are fixable and within control. Heinz will instead invest in marketing and research and development. Fourth quarter sales and revenue for the packaged foods company were down, and their full-year guidance for sales and profit also missed estimates. Cineplex profit was down in the fourth quarter as a drop in moviegoers hurt box office revenue. Theater attendance fell close to 9% in the quarter. The company says 2025 lacked big blockbuster films, but expects this to change in 26. On the upside, the Toronto-based company's revenue met estimates with international programming and premium experiences being major contributors to attendance. And a quick look at the markets, responding to some of the numbers probably that we're about to talk about. And you can see all of them well into the green right now. And the Dow well above 50,000, 50,400. And the NASDAQ up, and even the S&P 500 inching closer to 7,000. Okay, after a government shutdown, January's U.S. data on unemployment statistics has been released. The unemployment rate, 4.3%. The estimate was 4.4%. Joining us now is Alex Gracino, Global Chief Economist at Manulife Wealth and Asset Management. Alex, thanks as always for joining us. The numbers just dropping today. I guess that first number, we'll get your thoughts on that. The unemployment rate slightly lower than estimates.
Yep. Thanks for having me on. The numbers today are very clearly stronger than a lot of people expected. I think the bottom line here is really that it certainly puts to bed the idea that the Fed's in any rush to ease rates at some point soon. Overall, when you look at it, the headline figure comfortably beat, effectively doubling consensus, going up 130K versus 65. Critically, the unemployment rate also fell by a little bit. And the revisions were within a reasonable band, and also the annual revisions were comfortably within an acceptable range given what we're expecting for the full year of 2025 revisions. So overall, pretty strong, and we also saw a slight tightening of overall labor market conditions, so positive overall.
Sorry, John, I'm going to let you get in a second. I just want to add a quick follow-up. Any clear reasons for the strong showing?
No, this is very much a surprise. I think the high end of the consensus or the range of estimates was somewhere around 100K, so at 130,000, you're above even that. I'd been concerned that the month was going to be distorted by just weather-related factors, and January tends to be a bit of a messy month. So overall, positive. There's not a lot to see here that I see as being negative just yet.
Okay, John, you want to join in?
Yeah, absolutely. Because I'm glad I'm not a betting man on this one, because I would have taken the under on the number. Because after looking at the JOLTS data, the Challenger data we've seen recently, the ISM employment, the ADP numbers, all of them were showing sort of a little weaker than expected. So I really would have, like I say, expected on the downside. So I'm quite surprised by this. But I think you're absolutely right, Alex. I think this takes away any sort of idea that we're going to get a loosening of monetary policy or cutting rates anytime soon. But I guess the bigger thing is that what your comment is, what you're thinking we'll get Friday then on the inflation data, because it's the combination of the two. Which do you think they're leaning on more, sort of, if we start getting weaker employment numbers, or whether or not core inflation starts to finally come down?
So I think at this stage, we're very much data dependent. The Federal Reserve is still very much Chairman Powell's Fed. And what that means is they're going to look at the data. This to us says that there's no real compelling reason to cut. So if they wait for inflation, even if it is more favorable, it just gives them more time to decide what they want to ultimately do. And I would agree with you 100%. I was certainly worried about a downside surprise, especially given the weather data. So a nice way to start the year for non-farm payrolls.
And with the likelihood that it may sit for a bit, the markets have baked this in, I think, expecting decreases. Will that cause any repercussions for the markets, do you think?
I don't think so, because when you look at the Fed's path over the course of 2026, the real inflection point comes when Kevin Warsh is nominated and likely approved as chairman of the Federal Reserve. As that happens, there's a very clear bias towards incremental cuts. So we do still think we get that. It looks like it's increasingly likely that it's more in the back half of the year, though.
John, you want to...
Sorry. No. That sort of clears it up. Like I say, I agree with you on that call in terms of the change in the Federal Reserve. I mean, you're not going to see a major change right now. Kevin Hassett's out and off the board, and Warsh is going to come in and take that additional spot. But the overall census of the board seems to be still to wait and be on a little bit more sort of stay where they are in place for a while, unless you see substantially weaker data. I don't know. Would you agree?
I think so, but I think one of the jobs that Kevin Warsh will have as he comes in is to effectively convince the other members of the FOMC that higher productivity is in fact the order of the day, and that with cooling inflation, you can actually afford to start easing up on interest rates a little bit more. And I think, again, the argument is always just going back towards whatever their concept of neutral is, and 3% is a fairly uncontroversial level.
And looking at some of these numbers and possibly freezing, seeing no change when it comes to the rate, will this further expand the K-shaped economy right now?
I don't think so, but I do think we're at a very interesting inflection point right now when you look at where the data is heading. We've recently got a wave of actually incrementally positive data, and that's just been starting to get pushed back against with things like weaker retail sales. So we think that there's a little bit of catch up that happened post-government shutdown with some of the data releases, and we think over the next 3 to 4 weeks, other consumption-related metrics, areas like industrial production, we'll see if there's actually some uptick on the back of some fairly positive prints around things like the ISM. Durable goods orders have also been quite strong, and now a pretty solid payrolls report also would suggest perhaps the risk is actually that we don't actually get a slowdown, which is sort of what we thought would happen in the first part of the year.
What might be red flags for that then?
Red flags in terms of the economy just sailing right.
Yeah, with some of the sales numbers that you were just talking about.
I'm really closely focused in on U.S. consumption right now. I think the very short story is that without the consumer slowing down, it's really hard to see the U.S. slow down materially either, which paints an incrementally more benign picture. To be clear, we'd always been fairly optimistic about the second half of the year. We just thought that there was a little bit of a spot that we had to get through for the first few months of 2026.
And then any spillover for Canada in any of these numbers, or is there any impact it'll have on us?
I think incrementally, probably not at the margin. I think it does signal that the United States is strong, which usually means Canada is in a good spot. But Canada is certainly on the process of plotting its own path at this stage. We do think Canada still has modest growth this year, clearly with risks around what happens with USMCA.
Okay, we'll leave it there. Alex, thanks as always for joining us.
Thank you.
Alex Grissino is Global Chief Economist at Manulife Wealth and Asset Management. Up next, we'll hear from the CEO of Columbia Sportswear about the company's plans for the year ahead and, of course, that Super Bowl ad. It was unique. And, of course, our phone lines are open. John Zechner, chair and founder of J. Zechner Associates, is taking your questions on stocks. Call us at 1-855-326-6266. Email firstcall@bellmedia.ca. Columbia Sportswear is projecting modest growth in revenue and profit, with gains mostly in the second half of the year. To talk more about the earnings from the most recent quarter and the apparel company's plans for the year, we spoke with Columbia CEO Tim Boyle.
The comparative quarter from the prior year. But, we're solid and we've got a great balance sheet, and we've got great plans to go forward and continue to grow the business.
And were tariffs one of the main issues for this? What were some of the struggles for you in the last quarter?
Well, certainly tariffs are impactful. About 60% of our business is inside the U.S., and we import almost everything that we sell. So as everyone knows, it's a chaotic tariff environment in the U.S., and we're fortunate that we have a big business outside the U.S., especially in Canada. But yeah, tariffs are causing issues with virtually everybody that operates in this space, and us as well.
Have you looked at trying to bring manufacturing into the U.S.? Is that possible for you?
We've looked into it, but unfortunately, all of the infrastructure from making the fabrics to the technology around being a tailor and building products in the U.S., especially both footwear and apparel, is virtually impossible. The factories we work with that manufacture footwear, as an example, in Asia, have about 100,000 employees, and there's no way you could gather people in the U.S. to work in this kind of a business making apparel and footwear. So It's literally impossible.
So what do you expect then for the next little while? Because I was just thinking, over the last 4 years, you had steady growth for years. The last 4 years since the pandemic, as you mentioned, has been a bit of a struggle. How do you break through that?
Well, for us, it's all about product. So we're very good at manufacturing product and designing products which are useful around the world and in great weather conditions, both cold and warm. And we've probably been under-investing in our marketing efforts. So that's an area where we're focusing time and effort and getting ourselves better, more visibility to, especially to the younger consumers that we're looking for.
And what kind of a response have you had? You've launched a couple of campaigns, Accelerate Growth and Engineered for Whatever. How are they working? Are you getting a response to those?
Those have been very well received. You know, these things don't happen overnight, but they've been very well received. And you probably recognize some of the, what we call activations that we've done over the last several months, just to be different, to portray ourselves as having a better sense of humor than many of our competitors. You know, some of our competitors treat their garments so seriously, and we make garments which are certainly capable of keeping you warm or cool, regardless of the temperatures or the environment. But we'd like to take ourselves a little less seriously.
And we're going to get to your beer ad in just a second, but I want to talk a little bit more about the international markets first, Canada being one of them. Are you looking, they outperform the U.S., are you looking at continuing to grow those areas? Do you see more opportunities outside of the U.S.?
Yeah, our businesses outside of the U.S. are growing more rapidly than the U.S. Obviously, the chaotic tariffs are impactful here in the U.S., and there's great markets around the world that we're starting to recognize that we can have a solid business, and that would include markets in South America, in the Middle East. We have a good business in the Middle East, surprisingly, especially in winter clothing, and we have great business in Europe, and Canada has been a long time market for us. It's quite close to the U.S., and we appreciate the business there.
How are you, I have to ask, how are you marketing winter clothing in the Middle East?
Well, you know, it's interesting when consumers are traveling from the Middle East to Europe for a summer break or whatever, they're so used to being in hot weather that they get chilled easily. So they're buying both base layer underwear to be worn when they're traveling in Europe in the summertime, and jackets. So it's a good business for us, and the brand is well known and well respected there.
All right, and it's been, I guess, about 5 months, 4 months. I'm trying to do the math. No, it's only been 3 months since your son Joe became co-president, along with Peter Bragdon. How has that transition been, and what has it been like for you to see that?
Well, it's been great. You know, both of those people. My son is obviously, we kid around him being at the company since 1980. You know, and he's when he was born. It's a small family business at that time, and so we've grown it together. And Peter's been with us for many, many years. Initially as an outside attorney for the company, and then joined us as general counsel, and he's been with the company a long time. And his responsibilities over time have included not only being the company's attorney, but also managing our international businesses, especially those in the Middle East and South America.
Okay, now we're almost out of this, but I want to talk about the bear. I won't say the proper term for it, but the bear beer. We'll leave it at that. How's the response been to that Super Bowl commercial, which I watched, and actually I thought it was hilarious.
Well, you know, it's been a lot of fun, and the premise there was, you know, outdoors people, there's a very few times of the year where they're all going to be inside, and that's certainly in the U.S. Super Bowl Sunday. And if they're in their homes watching a television show, a game, they're going to be mostly watching commercials. And the biggest spenders on Super Bowl Sunday are beer commercials. And so we thought, you know, let's make a commercial for beer that nobody else can make. And I think we were successful.
The beer is actually available. Limited editions right now. Columbia CEO Tim Boyle. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a downgrade for Vizsla Silver. Let's take a look at some of the notable analyst calls and recommendations. Wells Fargo Securities analyst Michael Bloom cut the recommendation on Rockpoint gas storage Class A to equal weight from overweight. Price target set to $30. Stifel Canada analyst Cole McGill cut the recommendation on foreign mining to hold from buy, setting the price target to $6.60, implying a 0.3% decrease from last price. And Vizsla Silver was downgraded at National Bank Financial to sector perform from outperform on expected delays at the Canadian miners' Panuco project in Mexico after the deaths of workers recently. Analyst Don DeMarco sees the project being pushed out after the recent deaths, resulting in a more conservative outlook. He says, quote, "The situation remains fluid and we are working to better understand the risks and mitigating factors that support our model estimates," adding that Vizsla's focus remains on working to support the investigation during the difficult time that is unfolding there. Now, he lowered the price target to $6.50 from $10.50. When we come back, John Zechner, chair and founder of J. Zechner Associates, takes your questions on First Call. Time for First Call, and our first caller is Tony from Montreal. Hey, Tony.
Hey, how are you, gentlemen? Good morning.
Good morning.
Excellent. Bombardier, they're doing great. Could be one of Canada's biggest turnaround stories. And, John, what do you think about Canada ordering the Saab Gripen fighters? I'd love your take on that, and have a beautiful day.
Cheers, Tony.
Yeah, in terms of Bombardier, we've actually lightened up a lot on things recently, and it's strictly a valuation story. We started buying this a couple of years ago. The stock was trading sort of in the $40 to $50 range. It was trading about 8 to 10 times forward earnings, and was trading about 3 times operating cash flow. And they were doing, this great turnaround on the business jets, consolidating the businesses, which they had to do following the pandemic. That they obviously gotten out of the regional jet business, and they've had a better focus for the last couple of years generating free cash flow. Problem is, stock had a great run, and currently they're trading sort of around 13 times operating cash flow, so significant premium to that. They're still winning business, as we talked about earlier. The Challenger is sort of a superior jet to the Gulfstream, and they're getting great business there, and I think they'll continue to grow. I'm just more valuation sensitive, so I'm just finding other things. So we've, still got a tag end of a position in the name, and I've still got it on the radar screen. I'd probably buy it on weakness, but at current levels, no, I'm certainly not adding to it, and we have been a seller recently.
Okay, let's get into the emails now. This one's from Richie. Good morning, gentlemen. My question is on Constellation Software. I understand that the president left, and also the fact of AI possibly having an impact in the future, but what I don't understand is how the analysts are forecasting a $4,600 value, and all it seems to be doing is going down approximately more than $2,000 in the last 2 months. If you can kindly give me your outlook on the company, and would you buy at this price? John.
Well, that's interesting, because we actually recently bought it for the first time in almost forever. Because the stock, to me, again, it was a valuation story. It was just too expensive. It was trading at 20 plus times operating cash flow, over 30 times earnings. They had a great sort of acquisition-oriented growth strategy that's worked for years on buying these smaller verticals and incorporating them in, and the business model worked. But obviously, the worries about SaaS, like software as a service, are just really focused dramatically on a company like Constellation, because their companies seemed probably more susceptible to sort of incurrence from AI than almost anybody else. I don't remember seeing a stock drop 50% or more than 50% from its peak without missing a single earnings estimate or anything else like that. It's strictly been a valuation, and obviously Mark Leonard leaving. He was the architect of the entire move. And the growth over the last number of years, and people worried without him there, they can't steer this ship. But we could spend a lot of time arguing about the importance of a CEO to a company like this. If he would never bought Apple in 2013, when Steve Jobs passed away, if you had no good confidence there. And I think Tim Cook have proven you can run a great company as a new CEO. So Constellation now is at a much more reasonable multiple, about 12, 13 times operating cash flow, over 20 times earnings. So I'm going to watch for the next couple of quarters quarters. We bought it. It's cheap, and see if we get a bit of a, you're not going to get back to those targets as the caller said about 4,600 or 5,000. But hey, at 2,400 right now, I don't need anything close to that to get a decent return.
Okay, let's get one more email in. This one from Rob. My question is regarding Allied Property REIT. It seems to me that this company is still going backwards in their attempts to right the ship. Is this even an investable equity at this point?
Interesting question. It's, it is collapsed, and we haven't owned any REITs actually for a while. I've got it on the radar screen right now. They announced last night a major financing they've got to do, to sort of effectively right the ship, get some capital in, and it's about a $500 million deal. They got some decent backers on it. I think it'll have to be done at a price substantially lower than the current market price, which is around 14. So I'm going to see where they price this deal. I expect the stock might come under pressure a little bit, and I might look at it based on, going forward. So it's sort of getting to a point where I'm getting a little more interest. I'm sort of more value oriented on that basis. I think it's solid properties that they have. And I think you might have seen some of the worst of the cycle. So it's definitely on the radar screen. I'm looking at it. I would not be out there buying it this morning at 14. I'd be watching, hey, what's going to happen with this deal? Where is it going to be priced? And, it's a sizable raise.
We got to wrap it up there, John, but thank you as always for joining us.
Thanks, Roger.
John Zechner is chair and founder of J. Zechner Associates. Andrew Bell's up next with the Open. Trading gets underway in just over 30 minutes. Have a great day.